welcome to the daily global macro and technical wrap. Today we're taking a massive overnight geopolitical shift and translating it straight into actionable technical setups for you. Let's just jump right in. So first up, let's talk about how Wall Street reacted to the weekend headlines. Traders are actually calling this the Axios Put. It's this growing belief that geopolitical flare-ups are basically followed by super swift de-escalation, and that's exactly what's triggering these massive Monday rallies. I mean, Wall Street completely shook off its weekend fears. The Dow closed above 52,000 for the literal first time, and the Nasdaq jumped 2.1%. Basically, investors quietly packed away their emergency umbrellas, decided not to panic, and just let Monday do all the heavy lifting.
And you can really see this deflating risk premium playing out perfectly. Over in the Middle East, US and Iranian officials are heading into Doha discussions, and crucially, that 60-day transit arrangement in the Strait of Hormuz is holding steady. Because of this cautious optimism, we're seeing Brent crude ease right back towards $72 a barrel. And as a direct result, safe haven demand is dropping off, pulling both the US dollar and gold down with it. The market is very clearly pricing in diplomacy right now.
Now, looking at the domestic Indian markets, it's a total contrast. You know, sometimes the bond market whispers, while equities absolutely shout. The Nifty slipped just a bit, down 0.46% to 23,946, mostly on IT and auto profit booking. But quietly, the bond market totally stole the show. The 10-year G-Sec yield eased down to a 14-week low. That's driven by robust foreign inflows and those stable crude prices we were just talking about. Meanwhile, the rupee weakened just a hair to 94.54, mostly pressured by some late dollar demand from foreign banks.
Okay, so the crucial takeaway here is that today, the focus totally shifts away from geopolitics and right back to hard economic data. We have a seriously heavy macro docket driving today's volatility. We're looking at China PMI, UK GDP, Canadian GDP, the US JOLTS job openings, and the Chicago PMI. Oh, and we're also watching German inflation and retail sales really closely. And actually, speaking of Germany, maybe spare a thought for their national football team today. After a shock defeat to Paraguay, they just found out the hard way that unlike inflation, goals do not always revert to the mean. All right, let's map all this fundamental data directly onto our technical levels. Looking at the DXY, the dollar's downward momentum definitely continued on those US-Iran headlines, but it's anchored by the 10-year Treasury yield sitting at 4.37%, making the index a solid buy on dips ahead of that US JOLTS data. You're going to want to watch for support at 100.89 and resistance at 101.41. Now for the euro-dollar, the play here is to sell on the rise ahead of the German and French data, with a hard ceiling at 1.1447 and your floor is sitting at 1.1388.
And providing the fundamental anchor for that euro-dollar resistance level, we've got this very direct statement from ECB President Christine Lagarde. She explicitly rejected the whole insurance hike framing, pointing out that their decision was, quote, robust across a range of scenarios. Basically, this tells us that going forward, those exact data releases we just covered are going to strictly dictate the trend. The central bank is highly data dependent right now.
Moving right along to the British pound, that recent move up finally found a hard ceiling. Resistance hit exactly at 1.3265. And that's a key level because it perfectly lines up with the 21-week moving average. Now, if it breaks that, it opens up a target of 1.3326. But for now, the tactical view is to just sell on the rise. Interestingly, though, the market is also pricing in domestic politics here, as frontrunner Andy Burnham is out there promising massive regional autonomy. I guess despite history's lessons, markets still tend to take politicians at their word right before an election.
But guys, here is the number that absolutely defined the early Asia trading session today, 162. The dollar-yen broke its resistance at 161.94 and literally smashed right through the 162 handle. I mean, you'd have to go back almost 40 years to find yen charts that look anything like this. We are officially operating in completely uncharted territory here.
And because we are in that uncharted 40-year territory, your tactical positioning needs to be incredibly precise. If you were playing our previous recommendation to sell on the rise, well, that breakout definitely would have stopped you out. So what is the play now? You get right back to selling here on the rise, but you absolutely must keep your stops razor thin, right around that 162 mark. And be sure to keep a very close eye on the support levels below, at 161.94 and 160.55.
Finally, let's bring it back to the domestic charts. For the dollar rupee, despite that custodial dollar demand we saw from foreign banks earlier, it really remains a clear sell on the rise. Resistance is firmly capped at 94.92, with immediate support sitting down at 94.52. As for the Nifty, we're definitely looking at a buy-on-dip strategy here. We've got a target of 24,344 right in our sights. And keep in mind, while IT and auto lagged a bit, the metals and pharma sectors are showing some incredible resilience right now, and that's providing really great structural support for the index right around the 23,900 level.
So that brings us to the ultimate question for today's session. Will the incredibly heavy macro data docket we're facing today completely invalidate these highly structured support and resistance lines? Look, when the economic calendar is this packed, volatility is basically guaranteed. Your job is to stay tactical, watch those stops closely, and see if the fundamental surprises actually manage to break the technical charts. Keep your eyes on those levels and stay sharp out there.